As the owner of a CPA firm that works specifically with SaaS founders, SaaS businesses that are looking to grow, one of the most common questions that our team gets is, how are we taxed differently than a traditional business? And the truth is, you're not. You're taxed just like any other business. Now, what's different is that you have a long list of unique tax considerations that not every traditional business has to deal with. So it's less about you being taxed differently as it is more about you having nuances that other businesses don't need to deal with. And so here's a list. We're just going to go through five of the five most common nuances you have to deal with. And the first one, you probably could have guessed it, is revenue recognition. Whereas most businesses recognize their revenue, all of the revenue at point of sale or completion of a project, SaaS companies typically use a subscription model. And that means your revenue has to be recognized differently over time. And so that brings us to number two, sales tax. It gets complicated really quickly if you sell your product everywhere in the country, which you probably do. You might even sell it in other countries. And some jurisdictions consider SaaS eligible for standard sales tax, some don't. And there's over 11,000 jurisdictions just in the United States alone. So you can see how that would get hairy pretty quickly, the compliance of each one. And that brings us to number three, which is nexus rules. You may have tax obligations in places you aren't physically located just because your customers are. And with sales tax specifically, the nexus there, sometimes you're required to report after a threshold of dollars sold in that jurisdiction. Sometimes you're required to report after a number of transactions in a jurisdiction. So again, you can see where you could quickly get into the weeds of this, where traditional businesses might not have to. And number four, unless you want to restrict your customers to the United States, you'll probably need to deal with international tax considerations. You may even have business partners that live in a different country than you. And if we're looking long term, number five, due to the high margins and low costs once the product is developed, SaaS companies need to think more carefully about how they want to write off their initial investment. You'll likely be running at a loss, right, when you're pre-revenue, and you want to make sure that that serves you in the years to come when you're more profitable. And so it requires a multi-year tax planning strategy to make sure you're as efficient as possible over the life of your investment in this business. And finally, kind of a bonus sixth one, another consideration is payroll taxes and stock compensation. In the SaaS model, it's very common that with your employees, particularly those hired during the startup phases when you don't have a lot of funding, they receive a significant part of their pay as stock comp, RSUs. And while stock comp is a very beneficial arrangement when you're short on cash and your employees are really contributing to the business, it comes with a host of additional tax considerations, both for the business and the employee who received it. And so there's five nuances to consider as a SaaS founder. So thank you. And please don't forget to like and subscribe.